Good morning, everyone. Thank you for joining us today and welcome to this webinar on supply chain cost techniques and their impact on business performance. My name is Stephen Drummond and I'm joined today by my colleague Jimmy Moore. We're both supply chain advisors working in the supply chain solutions team within Invest Northern Ireland. This webinar is one of the series on supply chain topics. We hope you find them useful and they're available on the events section of the Invest Northern Ireland website. Today's webinar is aimed at developing understanding of the cost improvement process related to supply chain, and hopefully to leave you more informed about how to assess supply chain costs and go about tackling them. After the presentation, we will jointly take your questions, and you can add questions in the chat box. Thank you very much for your attendance, and we will now get the presentation started. Cost management and supply chain is a large subject area. We're going to focus on important aspects around the topic within the limited time available. We hope by the end of the webinar you will have a better understanding of why supply chain cost management is critical to a manufacturing business, where it impacts the performance of the business, how to go about making improvements to supply chain cost management. And we will finish with some general points on cost reduction process. This section covers why should you be concerned with supply chain cost management. Cost management applies to all businesses and industrial sectors. For the purpose of this webinar, we are focusing on supply chain aspects relevant to the manufacturing sector. Over recent years, the wider environment in which businesses operate has faced numerous shocks. From worldwide economic crisis in 2008 to Brexit, COVID, war in Ukraine, and large-scale supply chain problems. As a result, supply chain costs have been very difficult to manage. The issues that are ahead of us may also prove extremely challenging. Geopolitics, environmental changes, industrial strategies, and that's just the ones we know about. So the ability to manage and control supply chain direct costs and impacts to the business is more important than ever. Manufacturing companies at the most simple level take inputs in the form of materials, transform them to add value, and sell the resulting goods to customers. The three themes of this presentation are shown on the slide. Supply chain manages the inputs to the process. The price paid to suppliers has an obvious effect on cost. Secondly, availability and quality of inputs, paces labour, and overhead efficiency. Finally, cash is said to be the lifeblood of any company. Excess inventory ties up cash that can be used to invest in the business or offset borrowing. Our intent in this section is not to give you a crash course in finance, but just to point out where supply chain impacts some of the financial measures. Companies are obliged to publish their accounts at least yearly. These documents are what your customers and suppliers see when they're assessing your company and deciding if they want to do business with you. Business accounts show the historic performance of your company, its financial health, based on measures such as profitability and strength of the balance sheet. Business accounts give a picture of how a company has performed in the past. Companies also measure financial performance internally, often referred to as cost accounting or budgeting, and this is normally the way companies manage their finances going forward. Sure, you're familiar with profit and loss statements. Profit and loss takes sales or income, less cost to leave the profit the company has made. A couple of points to note. In a manufacturing company, material typically makes up around 50% of cost, sometimes more, sometimes less. Supply chain will also impact labour and overhead costs if supplies are not managed effectively. Finally, profit represents returns for investment in the company. This investment comes with risk. Investors could get more putting their money in the bank, risk-free. What's the attraction to invest in this company? Poor supplier performance can impact sales as well as the company's reputation and drive additional costs. In addition to direct material spend and labour costs, supply chain managers should consider indirect costs within their control, such as energy pricing, consumable materials, PPE, etc. Another important business account document is the balance sheet. Companies with a strong balance sheet can invest and grow. Companies with a weak balance sheet can struggle with servicing debt, even paying their bills. The takeaway from the balance sheet are minimizing inventory frees up cash. Payment terms should always be considered when agreeing terms and conditions with suppliers.
Thank you, Stephen. I will now take you through how you can achieve cost savings through effective supply chain management and some of the tools you can employ. This is a map of the improvement areas we support in the supply chain solutions team and some of the tools and techniques associated with those areas. As you can see, it covers a wide range. So if there's something you need help with, please feel free to contact us and we provide support where we can. For the purpose of this webinar, though, we will focus on the areas and tools that will help you reduce costs, increase cash flow, and improve stability. These are broken down into direct materials costs, labour and overhead efficiency, and inventory and cash. First, we'll look at what approach you can take to reducing direct materials costs and some tools that will help achieve your financial targets. These are supply chain strategy, category management, should cost analysis, risk management, and sourcing. We'll begin with the need for a supply chain strategy that supports your business's overall strategy. Whereas having a supply chain strategy will not in itself deliver direct materials cost savings, having one is necessary to ensure the cost reduction measures you employ get the time and resource required to make them successful. If your company strategy does not state what its supply chain needs to deliver, it is likely that you will remain stuck in a tactical short-term problem-solving loop, and the time needed to reduce costs will not be made available. This is an example of a straightforward sales growth strategy which most companies will have employed at some stage. It is based on growing revenue by developing new markets and products and growing share of existing markets and products. It is not uncommon for businesses to focus heavily on business and product development to make this type of strategy a success. However, if we consider the other main success factors for the strategy, it is clear how we operate our supply chain function will have a significant effect on the areas of operations, finance, and environment. The most effective way to ensure this is to have a clear supply chain strategy linked to the overall company goals. This means supply chain management needs to move from a transactional approach to a strategic one. Most SMEs see supply chain management as a task-driven transactional function where management is by exception and senior figures only get involved if things don't happen as planned. To grow successfully, businesses need to move to a long-term approach to supply chain management and use it as a key cog in their strategic planning process. If a robust strategy is developed and employed, you'll see benefits through time and resource being allocated to material cost reduction and subsequent improvements to risk mitigation and improved customer satisfaction. One of the best direct ways to improve your buying power and so reduce costs is to take what is called a category management approach. This involves segmenting spend according to market sectors or value streams for manufacturing, and is very effective in linking your strategy for sourcing and purchasing materials with the requirements of the end user. Suppliers are chosen based on how well they can deliver the business needs of the category, where material cost is usually the primary driver. As a result of this focus, the supplier base and product portfolio becomes optimized in line with business needs, consolidated where it is too large and expanded where it is too small. Once categorized, suppliers can be segmented using the TAIL spend analysis tool. Here we analyze spend by material and supplier so we can categorize into strategic, tactical, and TAIL spend. A relates to strategic suppliers of products that usually have a design feature or where you purchase very high volumes. In this case, suppliers are partners and cost savings are negotiated and regularly shared through meetings and supplier relation management. Tactical spend refers to easily accessible products where your volume is significant. Price is a key factor, and there are many suppliers you can choose from. Here, you have an arm's length relationship with the suppliers and choose many tactical, usually price requirements. Tail spend is what is left. Low volumes of mostly commodities with lots of historical suppliers. For these products and suppliers, the best approach is to consolidate, which has the double effect of increasing buying power and reducing overhead costs associated with ordering, receiving, holding stock, and processing invoices. Once you have increased supplier leverage, the next step is to ensure you negotiate well. Successful negotiation relies on knowing the information you need to gather, recognizing what insights and analysis this data can give you, and how this can inform which negotiation strategy you may choose. A full webinar on this topic is available on our Supply Chain Solutions webpage, and we hold regular negotiation workshops. So if you would like more information, please get in touch. The next tool is should cost target pricing. When dealing with supplier and cost, it is very important to gain an understanding of what is used or consumed when manufacturing the products. If you already know in detail how their costs are built up, for example, material spend, labour, machine hours, and overheads, you will know what their target price should be, assuming a reasonable margin, and then you can negotiate accordingly. You can also take this approach a step further and use cost trend data for the inputs to predict how your supplier's cost will look in the coming quarters and use this as another negotiation tactic. Another area that has become very relevant in the past few years is supply chain risk management. Many companies have seen materials costs rise and efficiencies fall as a result of poor delivery performance and unexpected price rises. In many cases, this could have been avoided if they had some risk management in place. To give supply chain risk management some context, it is a similar approach to other audit-based risk systems you already have, such as health and safety management or financial management. As complexity of supply chain increases, either by remoteness or the number of links in the chain, so does the risk of price changes and delivery failure, which in turn will impact your costs when disruption occurs. A good way of identifying risks is looking at how vulnerable a supplier is to unexpected events. The greater the vulnerability, the bigger the risk. There are some well-established tools to help identify and predict supply chain risk. One such tool is the CrowdCheck model, which categorizes your suppliers according to the potential impact of supply chain failure on your business. Once a supplier is categorized, the model has built-in suggested actions for mitigation. It is a data-driven model, and once set up, is very easy to maintain. With supply chain risk, the key is to ensure any identified risks are followed up with actions. How and when you collect your data can be tailored to your circumstances, but once risks are identified, you need to work with your supply base to mitigate them. This takes time, so it's important that it remains visible and reviewed regularly through your management systems. Once implemented, your resilience will improve, and this will help avoid negative impacts of supply chain disruption to your product availability and, most importantly, direct material costs. The next element to consider is how you source and purchase your materials. Most companies are already working to improve this, as it is the most visible way of reducing costs to other parts of the business. However, recent supply chain disruption has changed the dynamics of sourcing materials. So moving the source of supply closer to home is now a strategic challenge for local businesses. Either way, tools you should employ are total cost model and supplier profiling, as well as seeking advice on where to source. It follows then that you should have a good understanding of what is driving you to look for new suppliers or outsource if you are currently producing the products. Make sure you know whether cost is driving change or are there other considerations like the need for additional capacity, improvement of service, or a reduction in lead time to provide a competitive advantage. If you are clear on what you need to achieve, this will lead to better downstream decision making. One way to ensure to have a realistic view is to adopt the total cost approach. As well as the purchase cost, you should consider what other direct and indirect costs there will be associated with the sourcing or new supplier activity. This takes some time, but when executed well, it leads to better decision making and results meeting expectations. Once you have considered the risks and costs of changing suppliers or outsourcing and decided what that is necessary, it is important that you are thorough in your approach. The steps you should include are clearly identify your requirements, define and document the scope of your requirement, carry out a search for new suppliers, create a request for quotation document, and finally, carry out audits and evaluate potential new partners. In conclusion, if carried out well, sourcing can be a very effective way to reduce your cost of materials. Finally, sustainability is an area that continues to be overlooked, but due to impending regulation, will become a significant cost factor in the short and medium term. As with other parts of the sourcing process, a defined approach can be used to ensure you're embedding appropriate levels of sustainability in how you select new suppliers. The next area to focus on is your labour and overhead costs. How you manage your supply chain can have both direct and indirect impact in this area. Supplier relationship management is something all companies should consider. It is probably the hardest supply chain element to quantify in terms of cost impact, but it is likely the most important to ensure successful delivery of all your other key success factors. For example, poor or unpredictable delivery or quality performance from a supplier will definitely impact how well your factory, warehouse, and customer service support teams can do their jobs. For strategic suppliers, supplier management is about moving to a collaborative approach, treating them as partners rather than transactional vendors. This means when problems occur or delivery and cost challenges need to be met, a strong, trust-based relationship already exists, so issues can be worked through, as both parties are invested in a longer-term goal. For tactical suppliers, it is still important to have good, accurate performance data sharing and regular communication so expectations are understood and problems quickly addressed. As with all business relationships, there needs to be a clear understanding on both sides of what is required. This can be achieved through the use of scorecards and supplier reviews. A scorecard is a data-based approach which provides clear visibility of what standards are expected and how both sides are performing. Then, through regular reviews, a good working relationships can be developed, so challenges can be discussed and a shared solution met. When implemented, a supplier relationship management approach can contribute to cost reduction and improve material delivery and quality. Scorecards can be tailored to what you require. Some businesses use very simple, basic scorecards showing what is most important to them, whereas others prefer to have in-depth analysis and lots of KPIs. You can choose what suits your business and make it work. The main point is to make sure you have some supplier performance visibility in place so efficiency in your business can be improved. Warehousing and logistics is the main area in supply chain management that has a direct impact to labour and overhead costs. There are varying opinions on how much this function costs the business, but it is accepted to be somewhere between 5 and 10% of the cost of sales. This is also often seen as a necessary cost of service, but these costs can be minimised while still retaining excellent service levels. As with negotiation, this is a very wide subject area and there are many tools to minimise cost. As such, we have an upcoming webinar and face-to-face workshops are planned to cover these topics. Please contact us if you're interested in attending these or need more help with this subject. The final area to consider is around how much or little inventory you should hold and the impact this has on your cash flow. So, how much does holding inventory cost? This is not widely understood, and a range of studies have shown it to be somewhere between 15 and 30% of the value of the inventory per annum, depending on the type of business. High levels of inventory can be caused by oversimplistic reorder systems and policies employed in a complex environment. The benefits of optimizing your inventory holding are therefore easy to see and understand. They are reduction of costs, storage costs, borrowing costs, obsolescence, handling, transport. And optimizing inventory improves the service and reduces your cash burden. Finally, excess inventory has got a direct relation to excess carbon. A good first step is to have an inventory strategy that suits your business. And one tool to consider is a usage variability matrix. It takes historical usage data and categorizes materials to provide a reorder policy that will ensure supply while minimizing inventory. This approach will include pushing the responsibility for inventory back on your supply base for products with constant demand. Employing the most suitable inventory strategy will have a positive impact on cash and cost. Inventory management techniques can be separated into approaches where you either commit to hold stock but optimize it, and those where you work to hold none or the minimum of stock. For the purpose of this webinar, we will look at reorder point, safety stock, and Kanban or vendor management inventory. The simplest, most effective approach to inventory management is to employ a reorder point for each material you choose to hold in stock. It's based on a calculation using historical demand, current demand, inventory levels, supplier lead times, and a buffer and safety stock. This is suitable where demand or supply are unpredictable, which in reality applies to most businesses right at this time. One important point is that you must review these reorder points regularly and change where necessary so they remain representative of recent demand. Otherwise, you will end up with too much or too little stock. Safety or buffer stock is an important part of the reorder point approach. This is based on maximum and average daily usage and supplier lead time. Product life cycles are important to consider when setting safety stock, as historical sales will give the wrong picture when heading for end of life. In this case, it will be best to change your inventory management approach for these parts and move to make to order. Product obsolescence is a risk area for any business that holds inventory. Writing off or downgrading stock has to come from the bottom line. This means for every £1 product written off, if your gross margin is 20%, you need to sell 5 to make up for that loss. It is vital, therefore, that you have a process to regularly analyze, make visible, and deal with aging stock and obsolete stock. Once the risk items are visible, you can take action to minimize the cost of obsolescence through design changes, supplier returns, or going to auction. Many businesses work to reducing their inventory of certain materials to zero through vendor management inventory. If you have a lot of leverage over particular suppliers or there are new suppliers trying to get your business, you can reduce your exposure to inventory by introducing systems where you only buy at point of use. These are usually in the form of Kanban, pull systems that the supplier maintains on your premises. These are very useful for low cost, high usage parts where the cost of transacting purchase orders and invoices is higher than the value of the parts themselves. If implemented well, they will free up cash for your businesses and improve overhead efficiency. Finally, you should always consider negotiating payment and lead time terms with your supplier. From a very basic financial point of view, with the cost of borrowing currently at around 12%, for every month of lead time you reduce or payment term you increase, you will save the equivalent of 1% margin for that part. This, of course, needs to be approached sensibly, as if you push your suppliers to take on too much cash responsibility, it could put them at risk of failure. I hand back to Stevie.
Thanks, Jimmy. In the final section, we discussed the process around supply chain cost management. All supply chain cost reduction initiatives start with an idea. It's good practice to have a formal process to record and then filter projects as shown in this slide. The intent here is to focus on projects that give the best returns in the shortest time with the least effort. This slide is a bit busy, but it shows some of the areas you might want to consider when assessing a complex project. The intent is to compare risk and reward, then decide on launching the project. There are numerous assessment models, and you are probably familiar with the SMART tool. Pick a process that works for you in this situation. When a price is agreed with a supplier, it should represent fair value for both parties. There may be an additional opportunity to work with the supplier to lower their cost and create additional value that can potentially be shared. Opportunities such as specification easement, design for manufacture, access to material pricing from your suppliers are all examples of this. For effective supply chain cost reduction, it's worth considering creating metrics and coordinating effort, especially if different functions are involved in the process. It's also important to keep your senior management team up to date and draw on their support. Responsibility for supply chain cost reduction should be clear to all individuals involved. It should form part of their roles and responsibilities. Some final thoughts on supply chain cost reduction. Get people involved. The more people involved, the more activity will happen. Get a pipeline operating. Think cash first, easy wins. You can't do everything at once, so you need to prioritize which projects are going to give you the best returns in the shortest possible time. Set aside time to work on this. It can't be something that you'll always do tomorrow. It needs to be worked on in a serious manner. Have targets and metrics. Publicize success. Early wins build momentum. When people see that these things are succeeding, they'll want to be involved. Get senior level support. It's critical to show that it's important to the senior members of the organization. Don't forget to manage risk. So what are the next steps? If you feel this is an area where you need help, a good starting point is to fill in our supply chain checklist. It covers many of the areas we discussed today and provides a framework for an initial conversation with one of our team. So what are the next steps? If you want to get in touch with us, visit the Invest Northern Ireland website and look for supply chain solutions, and we'll get back to you. Thank you. That concludes the presentation part of our webinar today. So we've got a few questions in. Let's start off with this one. Where's a good place to start to look for cost reductions? Do you want to have a shot at that one?
I'll start it anyway, Stevie. I think as the webinar just stated, that what you need to do first is really understand what's driving your costs. As you said, not everybody needs to be qualified or trained as an accountant to do this, but it might be an idea to start with them. They might have an insight on understanding, whoever does the accounts in your business, of where they think the costs are too high or what's driving too much costs. I would always suggest that you try and do a bit of analysis of your own systems. If you've got an ERP or an MRP system, or even just an ordinary system that you do your purchasing, do a bit of analysis of where your spend is, which suppliers, what products, how often, how much stock you're holding, all those types of things. So do a bit of a digging first of all, and again, that's something we can help companies with if they don't feel comfortable doing it themselves. And once you've got the analysis and you've got a few opinions from other people in the business other stakeholders who know what they're talking about, then it's down to the areas we identified. It's about looking, first of all, that's your direct material spend. It's always kind of the place you'd be expected to start within the business. Certainly your business owners or the shareholders or the finance people would definitely expect you to be looking at that first. It's always a good place to start. And that's about, as we said in the webinar, about find out are the costs that you're paying or the prices that you're paying, are they reasonable? If they're not, then are there other people out there that you could potentially get lower costs for that, by sourcing or benchmarking or using there are providers out there that can help you out with what costs should be in the market at this moment in time. A priori is one that I know of, but there are others that you can use as well. And then it's a matter of looking, once you've got your direct costs and you're happy, working out, well, is your supplier basically adding too much margin to what they're doing. You're working out what it costs for them, what's a reasonable margin for them, having those discussions with them by having a good relationship with them. Once you've got your direct costs looked at, then the other two areas are inventory and your indirect costs or your overheads. And I think as well, one thing to consider is that it'll depend on what size of company and what type of company that you are. Like SMEs won't necessarily have an awful lot of buying power over a lot of their suppliers. There might be one or two where they can go and have a good discussion about. But it might well be that they've got a factory that is suffering because of supplier performance. So again, go and do a bit of analysis, go and do a bit of watching to see, well, how much inefficiency is in their factory as a result of supply chain issues. And if you identify those areas, then you can work with your partners within your business, and you can get help from ourselves to try and look at the ways that indirect costs through better supply chain management, through better supplier performance, can improve your efficiency. And inventory, most people nowadays hold at least some inventory. As we highlighted earlier on, there's significant cost now because of the cost of borrowing to every pound of inventory that you have. So it's a case of, again, working on the methodologies we mentioned to try and get your inventory, and not necessarily used, but certainly optimized to make sure you've got enough to do what you need to do within your factory and for your customers, but at the same time, make sure you're not holding too much. So that's my view on it, Stevie.
Yeah, I'd agree with all of that. Yeah, I think inventory is usually the easiest place to start because it's there and you're looking at it, and as you said, optimizing it is the key word. It's not reducing it to zero. It's having the right amount of inventory and having the right stuff. So I agree with that. A couple more questions. By the way, you can still add questions on. We're still open to questions. There's a couple more on here. So the next one is, how do you deal with price increases from suppliers? So it's a very, very relevant question in the current sort of environment that we find ourselves in with high inflation. So companies are coming in with price increases, and we hear this a lot from companies with price increases on a regular basis. And really, I think what companies try to do is stem those, rather than just try to pass those price increases on to their customers. They're trying to push back on suppliers, which is exactly what they should be doing. So they're difficult to deal with, and I think that the best way to approach it is to say, look, tell me why that price is increasing. What is driving that increase? If you can get it, you can sort of break it down into a granular level, then you can see if it's a justified price increase or not, and if the level of increase is right for the increased cost that your supplier is incurring. As well, by having that conversation with your supplier, you're able to say, okay, well, say for example, they're heavily dependent on energy, and energy costs have gone up, and they want to pass that increase on. That's fair enough, and I think that you don't really have a huge amount of pushback. But when energy prices start coming down again, then that puts you in a position to say to the supplier, well, look, the price went up because energy increased, it's gone down, so we need to have a talk about the price again. So from that point of view, it's worth having that conversation for at least the future of your relationship with them. If it's a smaller, if it's not a strategic supplier that you're depending on, and it's stuff that you can get from other suppliers, it's worth having a look at the market again and going out and seeing, is that the market price that they're asking for, or are they basically trying to rinse you with a price increase that isn't justified? With your strategic suppliers, hopefully you'll have a contract or a service level agreement in place. If you don't have those in place with your suppliers, then that's something that you need to think about, because you're leaving yourself open to price increases or changes in terms and conditions. So it's worth having a look at who your strategic suppliers are, and do you have a contract in place. And that's probably the advice I would give on random price increases from suppliers.
Okay, very good. There's a question there on Somebody's asking about if you've got a bespoke type business, a project type business, how do you sell or promote strategic procurement to the board members? Maybe if I take that one, Stevie, to go, I think it's one that I've been involved with myself. Worked in companies that are mainly project focused on, they did make bespoke products, and it's about it's really getting into understanding what's going to make the board members tick, what's going to change their mind on the decisions they've already made in the past. And that's about getting into, well, what you want to do. You want to increase your sales and you want to increase your profit. That's basically what's the two things that the company wants. There's all the other strategic things that they want to do to support that, but that's the bottom line, really. That's what they want to go after. And if you look at what we were talking about from a cost saving point of view, and the impact of indirect costs to procurement, what we said in the webinar, like, those are the things that you go after. But I think from promoting and a change of mindset within the board level, it's about getting the data. Going in and say, okay, this is how much extra we are spending because we don't have the time or we don't have the resource to go in and try and improve on our costs. Or this is how much we're losing out. If it's stuff that's going to site or stuff that's going to a factory, this is the inefficiency we have as a result of a poorly managed supply chain. And that's why we need to make sure the supply chain, as part of the overall strategy, as part of the overall growth strategy and the cost reduction strategy, needs to be in there. And from that, then they will naturally ask the questions, well, how do you do that? Then it's about saying, okay, we need the systems, we need the processes, and most importantly, we need the people in place to be able to improve these things. So that's how I would answer that.
Sure. Okay, another one here. What are hidden factory costs? So it's a good question. Hidden factory costs are generally associated with operations. It's stuff where operations have to do work that isn't planned, or basically it sort of applies a 7 waste. The lean 7 waste, where people are having to move about, looking for tools or looking for parts or doing work that's unnecessary, really, or probably spending time that isn't adding value to the product, and we want to boil it all down. And I think that the availability and quality of parts that are supplied to production often has a big impact on that. If the parts aren't there when they're needed or aren't in the right place, then it directly affects the effectiveness and the smooth running of a production operation. And a lot of that basically comes down to just managing the supply base properly, making sure that stuff is coming in on time and in full, making sure that the right stuff is coming in when it's needed, and making sure it's to the correct quality. So it's really a key of supplier management and being successful at that, and taking away that noise from operations so that they have the ability to be efficient in what they're doing. And it works both ways as well. If operations are moving schedules about and pushing things in and out in the schedule, then it doesn't give the supply chain much of a chance to be efficient in what they're doing. So the two things have to work in parallel and have to support each other. So I think that's where the hidden factory costs come into this. And again, it's unplanned spend. It's stuff that gets spent, and because it's not recorded, nobody sees it, so it's hard to do something about it. So it's a case of bringing all that stuff to the surface, letting people see that it's there, so as they can get the root cause and start having an effect on it.
Okay, thanks, Stevie. Another question here is about somebody who's on saying their customers are not happy, or they're struggling to keep them on board because supplier price increases keep on coming, and more of them, and drop the margins. And any advice? Again, for that one, I point back to what we talked about with the should costs. First of all, get two sides of it. First of all, understanding, if you do your should cost and you find that the materials costs have gone up because they're commodities and that's just how much the cost. Transport has gone up. The price of labour wherever your suppliers are operating has gone up. and you find out that they are actually operating at a decent margin, or their margin is reducing too, then that's something at the very least you can share with your customers. Say, listen, we've done this analysis. We can show you that this is how the costs are built up. Nobody's fleecing in the market, like, and if anybody is giving lower prices than ourselves, then the chances are they're doing that, less than cost, and it's really dangerous to be dealing with a supplier like that. And then on the other side, if you find that actually costs have reduced a wee bit, and there is room for your suppliers maybe to reduce their margins a bit, or they are taking advantage of you not doing your research, then you go back in. If they are intransigent about that type of thing, then it's a matter of again sourcing. There'll be somebody out there who supplies that type of products who will do it for a slightly tighter margin, who wants the business that you're currently giving to the current suppliers. And if it's a case of if they're small volume, high value parts, the design type parts, then it's the type of thing you need to go and analyze. Is there a redesign needed for some of our products? If your supply or your supply chain is dictating that you're going to lose business, then you maybe just need to look at, well, do we need those particular parts in our products, or are we going to compete better with maybe something else? So that would how I'd answer that, Stevie.
Yeah, that sounds good. Yeah. There's one here, but can you tell us the link you mentioned where to find supply chain? So the link I talked about was if you want to get in touch with the Invest Northern Ireland supply chain team. So the best way to go about that is to go to the Invest Northern Ireland website and look for supply chain solutions in there, or periodically what we'll do is we'll put out a call for companies to engage with the team, so invite companies to do it. Or if you're a client of Invest Northern Ireland, then speak to your client executive or client manager, and they can get in touch with us directly as well, and we'll come. We're more than happy to come and have a chat with you to see how we can support you. I think that's about it as far as the questions go. You anything to add, Jimmy, just before we close it up?
Again, just to reiterate, if you are struggling, it is a very broad subject, and this is a very diluted version of it. So if you have any issues, we're very happy to come and have a chat with you and take you through in more detail, and maybe narrow it down into the areas where after a bit of analysis, help you with the analysis, narrow it down to the areas where maybe we can help the best, or where you can get the best bang for the buck. But just to say thank you very much for attending, and hopefully it's been of some help.
Thank you.